This is Golden Years, a roadmap to navigate retirement with Mark Cordner, the podcast.
So if I asked you what is historically the worst month for the stock market, what would you guess? Well, many would say October, which marked, of course, the start of the Great Depression and the Great Recession. That's a good guess. But the answer is actually September. So when you develop a risk strategy, Mark, does it need to take into, effect of these yearly ebb and flows of the market for consideration, or do we think that's overthinking it?
Well, we absolutely need to be conscious of the fact that there are ebbs and flows, particularly with stock market-based investments. There absolutely are going to be ebbs and flows. But I don't think we overthink it in the sense of trying to guess exactly when they're going to happen. Yes, there has been a somewhat consistent pattern in September, but the problem with trying to time things, one of the greatest mistakes that people make when they invest in the stock market is trying to time when to get in and when to get out, because you've got to get it right, both getting in and getting out, and that's extremely difficult. And the academic studies are overwhelmingly clear that no human being can consistently accurately predict the best time to get in or out of the market. And so I believe in building a portfolio that will withstand the ebbs and flows. And just like when you ride a roller coaster, you don't, jump off as it's starting to go down. You ride it out. It's the same thing with market-based investments. But for most people, we need to build what I call a two-pocket strategy, and where some of their money's in the market because we need to be there for long-term growth to outpace inflation, but we also need to have some money that's out of the market. So when the market's down, we can reach into those principal protected accounts that are completely safe, and that buys us time for the market to recover. So when we give ourselves at least two different options, two different pockets to be able to reach into, we can respond to whatever's happening in life without trying to second guess what the next blip in the market's going to be, because you miss the top 10 days in the market over a 25-year period, and you end up experience a very small portion of what those people experience who stayed the course and didn't jump in and jump out. There's an interesting study. It's called the Dalbar studies, D-A-L-B-A-R, Dalbar studies that are done on consumer behavior, and it basically indicates that your average stock market investor ends up with one-third. That's one-third of the market's natural returns, simply because they engage in these self-defeating behaviors, like trying to time when to get in and when to get out, and they make decisions based upon the historical performance of accounts, even though that historical performance has nothing to do with what's going to happen in the future, and then they fail to rebalance their accounts, to rebalance those allocations, and so because of that, again, most people end up with one-third of what they might otherwise have had, and that's where my job as a coach comes in, because a big part of what we do is talking people off the edge, as they go through this learning curve of understanding how markets work.
Fiona Gregg is the head of investor research at Vanguard, and they recently did a study on how people spend in the first 5 years of retirement, and she's calling it the do nothing or do it all phase.
Basically saw three different behaviors. About half of people take withdrawals at some point over the 5 years. And a quarter of people didn't touch the money for the full 5 years. And a quarter of people took it all out in the first year.
All right. So, some people doing this and some people doing that, right? It's all to each their own. But we talk about having an income plan so that the money is there. So, Mark, you also have to build a spending plan as well as that savings plan, right?
Oh, absolutely. And I think, so definitely there needs to be, a clear plan going forward as to how we're going to prepare for retirement in terms of saving, as you say. But when we get to retirement, the entire equation changes. Just like when mountain climbers face the greatest risk coming down the mountain versus going up, it's on the downside where we have to make a limited amount of money last for an undetermined amount of time. That's where the dangers are. And so, yes, we need to set up a spending plan, and we need to stress test that periodically. When she talks about 50% of the people basically making mistakes, I think that's because you've got at least that many that are do-it-yourselfers who just don't know what they don't know. So they think, for example, that if I get a 5% average rate of return, I can take 5% out of my account value and never run out of money. Well, that's a complete falsehood, because if their money's invested in the market, it's not linear. It's not like you're getting 5% each and every year. It's variable. Some years are positive, some years are negative. And so people who fall into those kind of patterns end up really destroying their economic security. So yes, we've got to get a plan set up. In my experience with my team, we often end up doing what we call a tiered spending plan. So in the early years, we're acknowledging human behavior, and that is the desire to go out and enjoy life's opportunities while health permits. And so people are spending more in the first 5 to 10 years. In our experience, we call it the go-go years. And then we get into the slow-go years where they're starting to spend a little bit less. They've checked the box, as it were, on the bucket list. And so we kind of tier down the spending. And then we get to the no-go years where we may tier the spending down even more. But, again, it's not a one-time set it and forget it kind of plan. We set up a plan like that, and then we just stress test it. Every 3 to 5 years, we're going back in and saying, okay, how is life happened? Did you spend more than you expected? Do we need to scale back? Has inflation, taken advantage of us, harmed us? And so, yes, absolutely get a plan in place, revisit it regularly, and let the professional and their tools help you. That's what we're here for.
On the show, we talk a lot about the fear of spending your retirement money. And it turns out the stars are sort of just like us. Listen to this. Actor Seth Rogen says he can relate, as he explained recently on the Armchair Expert podcast.
I'm afraid I'm going to die with too much money. That is my fear. I don't have children, and I'm afraid I'm going to die and be like, I could have had a good place on the beach. I'm saying, I don't want to die with $10 million in the bank that I could have spent doing fun, alive things.
Yeah.
You know what I mean?
A jet to Paris on a whim.
Yeah, exactly. I can look back. I could have been jetting.
Oh my gosh, that's never. I could have been jetting. Well, listen, I think a lot of us can identify with some of it. We don't have the millions of dollars like him to say I could have been jetting, that's for sure. But how do you help clients strike that right between the balance of spending and enjoying and making sure they don't run out of money, but making sure they're not holding back on the fun times too?
Well, that's a whole lot of conversation, and I'm not sure that any single human being ever gets that totally right, because none of us generally know exactly when we're going to die. Hopefully we don't know exactly when we're going to die. If we knew that, it'd be very easy to plan these things. But because we don't, typically people end up leaving money behind for the people that they love, because we need to be conservative in our expectations. And so there's two parts to that equation. For most Americans, we're not in Seth Rogen's situation where we're worried about leaving excessive amounts behind. For most people, it's how do we make a limited amount of money just last long enough? And so that's, I think, by far the bigger challenge. And that's absolutely where my team specializes, because we don't work with the Seth Rogens of the world. We work with mom and pop America purposely. We work with the people that the big wirehouses don't want to work with. People who have less than $1 million typically are our client. And so their issue is how do we make the money last so that we don't run out? And we're extremely good at helping people at that. But the flip side is we do have a number of clients who will never, ever spend through all the money that they have. And so then we have the fun opportunity of helping them learn to live up to their privileges, as we call it. Because many people who, like myself, I have a hard time spending money because I deal with these issues, and so I want to live under my means. But after doing that for decades, sometimes it gets hard to go out and spend. I experienced this just recently on this trip with my dad, where I was spending money somewhat freely, and was so glad because, memories are worth more than money. But this idea of living up to your privileges can be extremely difficult for some people who have been conditioned to savings. And so we're coaching those people, how do we create a structured spending plan? Sometimes we actually create a structured stream of income that's purely labeled paycheck. And because they know it's coming to them every month, they go out and they spend it because they know it's going to come every month that they live. And so we've got both sides of that equation. And it's really all about having real conversations. And if you do have too much money, like Seth says, well, I'm a big advocate of multiplying it by giving it away. There's all sorts of charitable things that we teach our clients to do to maximize their impact in the world. And so if you're charitably inclined and you want to leave a legacy that lasts beyond yourself, well, we can show you how to really, really multiply what you have to create a whole lot of good in the world, and do so with tax advantages. So it's a lot less painful for you and a lot better for the world. So yeah, I'd say there's two parts to that problem, and power to Seth, I'd say, because too many of these big income celebrities, sports people, movie star people run out of money. We never hear that backside of the story because they never had any kind of structure to their behavior. and they end up impoverished. And it's tragic, particularly with athletes who never got the training.
Yeah, I was just going to say, you hear a lot about it with athletes, the guys that are retired and now all of a sudden they're, working at Walmart or living on the street, quite frankly. And then you hear just crazy things like big celebrities, Michael Jackson, Prince, Aretha Franklin, that you would think out of the gazillion million dollars they ever had, a lot of them didn't have wills, if you can believe that. A lot of them didn't have estate planning. I mean, so you think if these folks can't get it together, it almost is more daunting to go, well, if they couldn't figure it out, how can I figure it out with maybe my $300,000 or $500,000,
Well, I actually have clients like that. I'm thinking of a particular client who everyone on this radio show would recognize his name, and he's working in his 60s of necessity. He's in his late 60s now, maybe 70, but he is working of necessity because he made tons of money in the music industry in the early days, but as a creative artist type, he didn't save a lot. And I'm not knocking him at all. It's a lot of it has to do with our upbringing, the people we associate with, all those things impact us. But I would say that if you don't want to be slave to your money, slave to the necessity of working, for example, then hire some good professionals. Don't do it yourself. You can be an incredibly good musician, an incredibly good athlete, an incredibly good entertainer, and not know a thing about money. And there's nothing wrong with hiring a professional to help you with that. You just want to make sure you get someone who's honest and who has the education and the experience to be able to help you. You got to vet these guys. Don't take the first advisor off the street that your buddy recommends.
A $2 million nest egg sounds like that would be enough for retirement. But what if we're talking about couples? So let's say they came in, they talked to you about a certain amount of money they have for savings. What factors do you consider first?
Well, certainly their expectations. I mean, that's the biggest thing. $2 million is certainly enough for most Americans to be able to retire at the level that they expect. But some people have more extravagant expectations. And in that case, I've had people come to me with, for example, $1 million and say, I want $100,000 a year for the rest of my life, purely off of that asset. Well, I'm saying, well, let's wait a minute. $100,000 a year into $1 million is 10 years of income. Are we allowed to include Social Security in your planning? Are we allowed to include pensions in your planning, for example? Is there real estate equity that can be included in your planning? So $1 million may not be enough for someone who has $100,000 expectations off of that investment alone. Certainly we can do $100,000 a year kind of income if we're able to look at their other assets, such as Social Security, possible pensions, real estate, and the like. But again, it really goes down to what each person's needs and expectations are, and what do they have to support it. So I would say $2 million is not necessary. I would never call that a magic number, the way some people do. Most people don't need quite that much who have more modest expectations. But again, it really boils down to what are your expectations. I've got clients who want $200,000 a year because they can't imagine living on less than that. Well, that's fine if your resources can support that. And so the discussion with them is the same as the discussion with someone who has $200,000. We've just got to look at what are your resources and what are your expectations. But absolutely, there is not a magic number, kind of one-size-fits-all answer for everyone. That answer is as diverse as there are people. So it boils down to expectations. What are your resources and what are your expectations?
Investment advisory services offered through Golden Years Financial LLC, a registered investment advisory firm. Insurance is offered through Golden Years Insurance Services. These firms do not provide legal or tax advice. Consult your own legal and tax advisors before taking actions that may have tax implications. Investing in securities involves risk, including the potential loss of principal. Insurance contracts principal protection is based on the claim-paying ability of the respective insurer. None of the information contained on this website shall constitute an offer to sell or solicit to buy a security or insurance product. The information and opinions contained on this site or requested from this site are provided by third parties believed to be reliable, but accuracy and completeness cannot be guaranteed. They are provided for informational purposes only and are not a solicitation to buy or sell any of the products mentioned. Any media logos and or trademarks contained herein are the property of their respective owners, and no endorsement by those owners of Mark Cordner, Golden Years Financial, or Golden Years Insurance is stated or implied.